Okie dokie. All right, let me hit the broadcast button. Okay, I think we are ready. Okay, so hello again, all of our participants in our first session on debit management and credit management. I say this at every session. I'm Bernice Jenkins. Well, first of all, I'm Bernice Jenkins. I am the Financial Literacy Director for the Southern Region, the National Association of Black Accountants, also known as NABA. Today we have Felicia Grant that is joining us again. Felicia is NABA's Financial Literacy Director for the Atlanta chapter. And so she will be here today to monitor your questions. If you are watching us from Zoom, you registered, you're watching us from the Zoom app, at the bottom of your screen or maybe to the side, you will see a Q&A box. Anytime throughout this presentation, please go ahead. We're here for you. Put your questions in that box. We're going to be monitoring that. And towards the end of the session, maybe the last 15 to 20 minutes of the session, we will entertain your questions. Again, we are here to help you. If any of you are watching us live on YouTube, you also have the opportunity to ask questions. So feel free to take advantage of that live chat box, the live comment box. I personally will be watching that. And in the last 10 to 15 minutes of our sessions, when we get to that Q&A section, we will be answering your questions live. So today, if you joined us last week, I introduced you guys to Francesca Ross Jones. Francesca is the of Making Common Sense of Credit. This is an awesome book. I'm not just saying it because I've known Francesca over the years. The book really does break down just the mystery behind how your credit score is calculated in a way that's understandable so that anybody can pick this book up and figure out how to fix their credit on their own. That's the goal of the book. And before I introduce Francesca, I wanted to read a couple of things from her foreword that I thought kind of sums up her passion behind what she does. She said that she's been working in the industry for the past 15 years, and due to her professional practice, finances wasn't her focus until she found herself with life happening to her as a single mother. So she says that she wrote this book to share principles that will help you correct some of the same mistakes that she's also experienced herself in the past. And she wants this book to leave you encouraged, empowered as you build a champion credit score and financial forecast. So today she's going to be talking about the black box. I think there's so much misconception regarding how your credit score is calculated. And a lot of times people don't really understand it until they find themselves needing a house, needing to get credit for a car, and then they are backpedaling to fix something. What we want you to do is understand your credit score so that you don't find yourself in a situation where you're having to backpedal and fix something later. So that's the goal of the presentation today. And we're gonna have Francesca to share her screen so that she can show you, take it away, and Felicia and I will drop off.
Good afternoon, everybody. Hope everybody's doing good this evening. Let's get right into it so that we can talk about credit, the anatomy of a great credit score. So we're going to talk about this evening, how does the credit scoring system work? What strategies create a good credit score? Which you may or may not be aware of that. Don't want to take too much time to talk about myself. I did get to do that last week, tell you guys a little bit about me, my passion, my journey with my credit score, and going from that challenge space now to a champion space But I am, as Bernie stated, Francesca Ross Jones. I am the owner of Common Sense Solutions. I like to think of us as a financial and business services boutique. My mantra or my mission is to empower men, women, young adults, everyone that comes into my path, just to empower them through financial literacy to help them to overcome any shame issues that they may have. That, life happens to us all. So we've all had some hiccups to happen along the way. And sometimes those hiccups keep us from realizing some of the dreams we have, whether that be home ownership, that be purchasing a nice vehicle without all the high mileage, with a lower interest rate, of course, securing that promotion on the job, securing that new position, whatever it is. Credit is powerful, as most of us know. The hard thing is that a lot of times we wait until we're ready to try to do something in life and where we need to lean on credit, and we're kind of in a situation where we can't. So let's talk a little bit about what my belief is of what is the anatomy of a great credit score. So it's basically three things that I kind of want to hit on this evening. It all starts with the credit report. Everyone knows what that credit report is. Everybody's all excited about the credit score, but the credit report is what actually the information, the data that's in the credit report is what spits out that famous credit score that everybody's concerned with, right? So we want to talk about demystifying the black box of the credit scoring system. So when we say black box, that's a term that's relatable to science and engineering, right? So it's something that we can view externally, but we want to know what's going on internally, right? So when you look at your credit score, kind of think of it as the same way. We know what the credit score is, those 3 digits, but why? What makes it up? How is it composed? Where does all this come from? And why is it important to us? Demystifying. We want to simplify it, break it down. And that's my goal, as Bernie stated, in making Common Sense of Credit, to break it down and make it so it's understandable for anyone to actually go through the steps and restore their credit, go through the steps and build credit, possibly, but managing, understanding how your credit is made up, what your credit score is made up of, and how to go about making it better. Also, the 5 main factors of the credit score, very important. Okay, so it all starts with the credit report, guys. So if we look here in this slide, we see the credit furnisher, and then we see, the CRA. So the credit furnishers are a couple of the people we have listed here. And the 3 major credit reporting agencies, of course, are Equifax, TransUnion, and Experian. Those are who you see when you pull your credit report. Credit reports in themselves can be challenging and difficult to understand because they originally were designed as tools for lenders. And you and I, the consumer, we were an afterthought in this whole process. The credit report gives lenders what they deem the background, the data, the history, the status of all the accounts that you have. And it helps them answer the following questions because they're most concerned about your credit worthiness, right? So how well do you repay your debts? How timely are you paying your bills? How much debt do you currently have? Now, the credit report doesn't automatically contain a credit score per se. The score must be requested separately. So we can see our credit report. Any of us have the ability to go out and see our credit report through various measures at any time on any day. But that credit score, that's not always easily available or accessible. And it's definitely most of the time when you see it be accessible and easy and it's free, it's really not free. And it's possibly not as accurate as we think. If a score is requested, the credit reporting agency uses their own credit scoring software program in which it analyzes the contents of your credit report and then it creates the credit score. So most everyone has different credit scores. So it's usually not the same on Equifax, TransUnion, and Experian, right? And that's because it's a couple of reasons. Each credit reporting agency uses their own software program. So what happens is over time, depending on what algorithms they're using, what type of data they're analyzing, and what populations they're looking at, that may change, right? As well as any type of software you use. Of course, you know, they update models all the time. And so that would change. One thing that is amazing is that as consumers, if we look back over time, originally, what was used most of the time is household accounts, right? To really determine what this credit score was going to be. So, you know, maybe your mom, your dad, your grandmother went down to the local store downtown and they were extended credit that way. And so for those who maybe didn't have a credit profile per se, or, you know, just moderate or low income, that was their way of determining if you could afford to buy this TV or get furniture on the furniture account and things like that. So scores vary by agency because only probably about 80% of your accounts are reporting on various agencies. So for instance, you may have some accounts that are reporting to Equifax that aren't reporting to TransUnion, or you may have some accounts that are reporting to Equifax and Experian that aren't reporting to TransUnion, and vice versa. The scoring model, it changes over time. I think right now they've just come out with the major scoring model is FICO. I'm sure a lot of you guys heard of FICO. There's two, and we'll get into that, that are most popular, but FICO is most popular when it comes to lending. And here I've just listed a couple of the factors that they're looking at when they are building this credit report for credit score, I'm sorry, for you. This is what they're looking at in the credit report. So everything listed here plays a vital role, and we'll talk more about these as we go along. All right, so FICO. What is FICO? What is Vantage? So there are a number of scoring models. FICO, of course, as I stated, is the one that we want to focus on the most, especially when we talk about credit restoration. FICO is the one that most lenders use. So it's going to be what you want to focus on when you are thinking about restoring your credit, you're building credit, because when you're having credit extended to you, 9 times out of 10, that is what the lender is going to be basing it by, FICO model. So FICO offers a classic model, and then they have, industry specific models for automobiles, mortgages, consumer finance companies. So your loans that we were just talking about, you know, where you go in and you're getting an installment loan from whoever the small town finance company is. We'll say that. We'll say more so finance companies. Each model has its own formula and its own scoring model. So if it's weird to you, maybe perhaps when you go to apply for a vehicle, that you've looked at your credit and you thought, oh, my credit score was 660, and you get there and they say, no, it's 589 according to us. It's because they are using the model that's general for automobile or vehicle financing. So there are different models and different ways that they're looking at it in order to extend this credit to you. And a lot of times that's why people get discouraged and they're upset when they go out to apply for credit, because they're not aware of this. And so it comes as a shock. The Vantage score is a competitor to FICO. Vantage is not used as widely. It is a collaborative effort between the bureaus. And I'll give you guys a good example. Vantage score is, I know Credit Karma is popular for a lot of people. That's a Vantage score. Usually when it's a score that you can access for free, it's Vantage. Again, it's not widely used in lending at this point because I don't think they just have a lot of data on it. Maybe we'll see as time progresses that some lenders may go to using Vantage. In my experience, Vantage is usually a whole lot different than what the FICO is. Honestly, that has been my experience with clients. They come in and they assume maybe they're in the 600s already. And then when we go and we look at the actual FICO, they're not. So the Vantage score is a score that's used. It's a competitive model. Like I say, it's a collaborative effort of the three bureaus. But for credit restoration or being considered to be extended credit, I would definitely focus on the FICO model, guys. All right, so the formula that FICO uses for the credit report and to analyze your credit worthiness. Here I have an example of what the ultimate goal is. So if you look at the odds here, what happened was they went and they did a study, and all the three bureaus pull 1.5 million random credit reports from each credit bureau. So they look at 2 years later, what was the results of consumers? So how did they pay their bills during that time, right? So right here, we're asking how likely were you to be 90 days late or worse over the next 2 years. So what they did was they went back, they looked at all that data from the prior 2 years, and they looked at who paid 90 days late or 120 days, or they were charged off in those last 2 years. They looked at the original report versus the updated report. And of course, the goal of this analysis was to figure out what these individuals that they pull randomly, what they may have in common, right? So the real question here was, what are the odds that these people will default on a loan if we extend credit to them over the next 24 months? And if you guys look at the credit scores, you do see that individuals in this study who had a credit score below 500, 89% of those people most likely had defaulted during that time period, and it was predicted that they may default again. So that's something to look at. And that's why I say when you are considering improving the credit score or repairing the credit or building per se, you definitely want to look at how FICO is judging that. And they're definitely looking at the next 24 months. That's when it's most critical. Anything that you do, if you get something charged off, if you pay late, the older it is, the less strenuous it is on the credit score, but we have to get to that place. So it can be detrimental, guys, anytime you let anything become late, et cetera, it can become detrimental. So we always want to try to keep away from that. So at this point, Even before getting online with us tonight, guys, you guys are aware of how important the credit score is in determining your credit worthiness, right? I think the main key to protecting your credit score is to monitor what's being reported about you. It's so crazy because most credit reports, I say at least 25% minimum, have some type of inaccuracies in them. So if we look here, each of us can get a free credit report by going to www.annualcreditreport.com. That's usually once a year. However, the pandemic has been going on. So COVID-19 has been here. And back in April, it was released that you are able to go and pull your credit report. I believe it's like it was once a month or once a week. I'm not sure because I don't really go there. I actually use my FICO as a credit monitoring for myself, but you have to pay for that. The only thing that you wouldn't be able to get when you go to annualcreditreport.com is your credit score, but you actually can pull your credit report. Why do we want to pull our credit report? Why is it important to do that? At least I think you should do it every 6 months. I know people who do it a lot often than that. It's because if you guys look here, I have some common errors most likely found on the credit report. And in our next session, we are going to talk more in depth about disputing and restoring your credit. But let's talk a little bit about these common errors. So mixing or merging consumer files. What do I mean by mixing or merging the consumer file? When the file is mixed or merged, usually what happens is maybe you and someone else share a common name. You may share some type of common similarities in your information. So maybe the name, maybe 7 of the 9 digits of your of your social security number, all kinds of weird stuff. We see this happen sometimes. When this happens, that means that, say for instance, you and I have similar social security number, or our names are similar. I may get some of your credit history report on my credit reports. You may get some of my credit history report on your credit reports. We oftentimes see that happen too in situations where you have senior, junior, things like that. So that can be bad, just because you don't want your information entangled or mixed up. And a lot of times it's hard to get it untangled when that's been done. So that's one thing you want to look for. A lot of times we don't look at our credit report, so we don't know if we have something reporting on there that doesn't belong to us. And a lot of times we get discouraged, guys, because when maybe we have a lower score at that time or a challenge score, we get discouraged and we just don't want to look at it at all. So that's not the way to be. I'm telling you guys, you can recover. If you are in an awkward space with your credit, you can recover. It's possible. Identity theft, as you guys know, that is probably the most widespread growing criminal activity going on is identity theft. And it's awful because who wants someone to get a hold of their information and go out and destroy their credit so that they can't go out and do things they would like to do, realize their dreams? But identity theft can be tough. It can be hard. Let's say, for instance, someone goes out and they apply for credit. They may use your social and your last name, but not use your first name and your address. That's a red flag. However, most of the time people are applying for credit and they're stealing identities. A lot of times they're doing this stuff online. You know, everything is so digital now. Everything is all about technology. So it's really important to check on your score. Inaccurate information reporting. You can have inaccurate information reporting on your credit report. You can have a trade line on there and they're reporting that you're 30 days late. You were never 30 days late. That can be detrimental. So you want to be checking on that. to make sure that payment status, account balance, all of that is correct. If you see it reporting on one where you're 30 days and you weren't 30 days on the other two, that's odd. Most of the time, that's not correct. So it's just actually going through your credit report, being very meticulous, and just looking to see what may be wrong there. Um, Illegal inquiries. We see this a lot, unfortunately, in the auto industry. Sometimes you say, for instance, you go in, you want to test drive a vehicle. So they want to size you up. The salesman may want to size you up and say, hey, I wonder if they can afford this car or whatever, whatever. You haven't signed anything, you haven't initiated any purchasing processes or said that you want to go through with anything. And then a couple of months later, you do decide to buy a car and you see all these inquiries from that. That's not, that's illegal. So, if you see that happening, you definitely need to get that taken care of. Inquiries, while they aren't as detrimental on the credit score, they do affect it, and too many is just not good. It's never good. It's a signal that you are shopping for credit, and that may look like a big risk to a potential lender for you. Let's see what else. Debt collection abuse. Okay, so what do we mean by debt collection abuse? You may have a account that originally you have the original creditor that you were with, then you have where it was sold to a collection agency, right? Then let's say, for instance, you don't pay that first collection agency, they sell it to another collection agency. It should not be reporting 2-3 times on your credit report. Even if it's reporting twice for the original creditor and the collection agency, under the original creditor, the balance shouldn't be reporting, because they sold the debt. So it should probably, the balance should just be reporting on the collection agency, not the original creditor. See that a lot, a whole lot, guys. So you definitely want to keep an eye on that. An exception would be a judgment or a public record, because that's not a actual reporting, as a trade line on the credit report. Another thing to be cautious of with that is re-aging. When you look on the credit report, you're looking at the date of last activity or date of delinquency. A lot of times when that account is being sold from this original creditor to collection agency 1 to collection agency 2, what they'll do is they'll call themselves wanting to change that date and re-age that debt, which should never happen. Have seen it happen, and sometimes it causes a major issue. So those are some things that you definitely want to take a look at. Now, let's jump into these 5 main parts of this credit score, okay? So, payment history. What's payment history, guys? How well have you paid your bills? Have you paid them on time? How often have you been delinquent? Of course, the first 2 years, as we stated, are the most impactful. However, a 30-day late is more detrimental than once that 30-day late. Let's say you have that 30-day and you pay on time for the next 6 to 9 months. It isn't as bad. It isn't calculating as bad then at that time, which is a good thing, because we definitely don't want that reporting to be hindering you. And a lot of times I tell people it takes time to recover. Once you have that one late payment hit, it takes time to recover. As you guys see, payment history is 35% of the credit score. So think about how many points that is when we looking at all the points that comprise the credit score, right? That's a major, that's the most important part, the most important chunk of that. So definitely try to make sure you're paying your bills on time. If you can't pay on time, you need to reach out to your creditor as soon as possible and say, hey, I'm having a problem. What options are available to me? As a consumer, there are always options available to you. The time of delinquency. the date of first delinquency is going to be so important. We kind of talked about that a little bit in the previous slide. You know, when were you delinquent on this count? How long has it been? They're going to look at that. The level of delinquency, 30 days is, if you get a 30-day late, my suggestion is to try to pay that bill as soon as possible. So let's get that delinquency out of the way. 60 days is worse than 30 days. 90 days is worse than 60 days. 120 is worse than 90. And then we get into the whole charging off and, you know, moving on from there, which becomes more and more detrimental. Guys, one late payment can hit you for 100 plus points. So keep that in mind. Past due notices. If you're past due, again, try to go ahead and pay that. Missing or skipping payments. If you have a missed payment or a skip payment, try to go ahead and cure that. Those late pays can be detrimental to the score, very detrimental. And it's going to be hard for you to apply for additional credit when they see that you have a hard time paying. Also, another thing is when you have, say for instance, you are in a situation where you're having a hard time paying, not paying your mortgage may be a sign that you just can't pay it. If you have $1,000 mortgage versus not paying your car note, you know, if you had both, it's not good to not pay either one. But, you know, if you have someone who says, oh, I'm not going to pay my mortgage, but I'm going to pay my car note, it's going to weigh a little bit more. It's not going to be a lot, but when you look at it overall, the signs and indications are going to be maybe you didn't pay the house payment because you really just didn't have the money to pay the house payment. So keep that in mind. Keep that in mind. Keep that in mind. All right. Our debt to credit limit ratio. So debt ratio. Revolving debt is the most important. We have installment, we have revolving. So installment, of course, is our mortgage, our vehicle loan, any type of, say you go out and take out a small loan to do whatever. That's installment. So the goal is our goal is to pay either something off, or we're going to pay it off. Whether it be we're paying a car off, something tangible, we're paying it off. Revolving is, hey, I have this credit card, I can go out, I can charge on the card, and then I can pay that off, and then I can use it again. So it's revolving. It's a constantly revolving door, right? That revolving debt, 30%. So what is your credit limit versus how much you owe right then? So if you have a credit limit of $1,000 and you owe $900, y'all, you are at 90% utilization. And if I tell you guys 30% of your credit score has to do with utilization, the bureaus, they love 30%. I stress less than 30%. I stress anywhere from 5 to 11%, honestly. So be careful with that. Please be careful with that. Don't get credit cards, run them up, not pay them. If you can, pay them off, pay them down every month. If you get in a situation where you are over that 30% utilization, don't go to the next credit card and start charging up, guys. Let's formulate a plan of action to start getting that down. It can be detrimental when you want to purchase a home when they see you have all this credit card debt. So keep that in mind. What else did I want to tell you guys about credit cards? Okay, some credit card tips. Yeah. Pay down as much as you can. Use every card. So if you have 3 credit cards per se, use every card at least every 3 months. So don't have a card and let it sit there and not utilize it. Anybody who has credit cards, and you probably know, if you are in a situation where your utilization is a little bit high during this pandemic, credit card limits have been being cut left and right. So be careful about that. Make sure you're using the card. They're either cutting limits or they are closing your account out because they see you owe a lot over here, but you don't owe anything to them. So they're just kind of, with everything going on with the economy, I guess that's what credit card companies, what lenders are calling risk-based lending. They're being smart about what they're lending to you. Don't ever close a credit card, guys, because then it affects your history. The length of time that you've had that particular trade line is very important when we look at the credit score. So don't close it. And oh yeah, don't ever pay off a credit card when you're purchasing a house right before the closing date, especially if it's something that they say, maybe it's something that's charged off, a credit card that gets charged off, and they tell you you're going to have to pay it. Don't do anything until they tell you to do it. So if it's like the day before closing and they say, hey, when you close tomorrow, you need to have this paid off. Pay it off, have that receipt. But if they don't tell you to do it before then, because what can happen is you can pay off something that's an old debt that they tell you they need paid, it can re-age it. So if you do it too early, what may happen is you may put yourself in a position where that particular account re-ages, it drops the credit score, and you can't close on your house. I've seen it happen. So be careful with that. Credit limits. Ask for an increase every 6 months, especially if you're paying right and you're keeping that utilization low. It's always a good thing to ask for an increase. And make sure that your credit limits are being reported, because sometimes that isn't happening. Spousal considerations. Guys, please, 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 if you can, don't get any joint credit cards with your spouse. Why? Keep everything separate, because what happens is if life gets hard and you guys have everything jointly and you default, you can't help him and he can't help you, or vice versa. So try to keep everything separate. It'll be good because, say for instance, something did happen and I had a $50,000 credit card. My husband has a credit card where he's charged up $10,000 on it, right? Times get hard, we get down to one income, I can transfer that over to my credit card. So that's a good thing to be able to do. Also, if you're in business, consider getting a business credit card, because, hey, those don't traditionally report to your credit unless you default on them. And that can kind of help you to free up and navigate and kind of curb some of this utilization situation that you have going on. But I talk about more of that in my book, guys. Okay, the average age of the credit file, or the length of credit history, you have to wait it out, guys. You can't make yourself have an trade line history of 6 years, 5 years if you're new starting out, or if you just didn't believe in having any type of trade lines or any credit. It's like a waiting game. So once you clear delinquencies, you just have to wait it out. 50% of your score definitely depends on your patience, you guys. So again, don't close the credit cards, especially the older ones, because you're killing your length of history, the age of your credit file. And every few months, definitely use those cards that you have. We don't want to leave anything sitting stagnant, because then we risk losing the credit limit, right? Which will affect our utilization, as well as possibly having the card closed out and losing the length of credit history as well. Mix of credit. So we talked about revolving, we talked about installment. The ideal mix of credit, guys, is a mortgage account or auto loan account and 3 to 4 credit cards. But again, that's only 10% of your credit score. So even if you have that awesome mix, be careful about how you're paying. Be careful about how much you owe. That's very important, okay? Inquiries. Only apply for credit when you need it. do not be out here just going mad applying for credit, y'all, just because you can, or because you have a credit score that says, oh, I can. Don't do it. You can get in over your head very fast. A hard inquiry is when you are trying to purchase a home, a vehicle, something that's tangible. Soft inquiry may be for a offer. You guys get all these pre-screen offers in the mail for credit cards and things of that nature. Maybe you're trying to apply for a job or a promotion at work. Those are soft inquiries, so they don't affect the credit score. They don't hurt the credit score, okay? When you look at your own credit on annualcreditreport.com or anything like that, that's not hurting your credit score. That's a soft inquiry. Hard inquiries do hit the credit score. They do impact it. Okay, and so the last thing I want to say about inquiries are with mortgage and auto inquiries. If you apply for, if you're shopping for a car or a house, they group into a 45-day window. They will group all of those inquiries. So you're going out, you're looking for a car, you're shopping for the best deal. They won't count if you have 12 of those in that same window period of time, just like a mortgage. They won't, it doesn't affect the credit score as detrimentally as if you are out here and say you start doing the mortgage process and then you say, oh, we're going to wait. And then you go and it's been 2-3 months, then we got to start over. So it's a bit different. Again, let's do recap so we can get some questions before our time gets up. Hope I haven't bored you guys, but I hope I did give you guys some good information tonight. So let's do a recap. Payment history. Pay your bills on time for at least 2 years. You will see a detrimental positive effect if you are rebuilding, if you're establishing credit. Because like we said, time and patience is going to be key, right? Debt to credit limit ratio. Keep it as close to 0% as possible. I say anywhere from 5 or 7 to 11% because we do want it to calculate that you are using your credit, okay? Average age of credit file. Plan to have accounts open as long as possible. Please don't go closing out credit cards just because you don't want to use them. Please use them at least once every couple of months, even if you don't need to. Or put a recurring bill on there. That's a great thing to do, whether it's a Netflix subscription, car insurance, things that you have to pay anyway, a utility bill. So that way we know that we're using the credit card, okay? Mix of credit. So you want to have a diverse account mix. Remember we said vehicle, mortgage, 3 or 4 credit cards, no more than that. You could have more than that, but that's a great mix. That's a great mix. Keep your hard inquiries to a bare minimum, guys. If you don't need it, don't just go out here shopping for credit. Just wait until you need it because it does affect how lenders will look at you when extending credit to you. So I have enjoyed going over the anatomy of a great credit score with you guys. This is session 1. We will be back for session 2 next week, and we'll talk more about credit restoration, the dispute process, and how that goes, and take some more questions. We're going to take as many questions as we can. If we have any, we'll get back with our beautiful host to find out. But if you guys are interested in making common sense of credit, you can visit any online retailer, Amazon, Barnes & Noble, Walmart, Books A Million, everybody to get this book. You can reach me with any of your questions. If you want a free credit discovery call consultation, you can also do that as well. I can be reached. You guys see here at Francesca at makingcommonsense.com. Again, I have enjoyed you, and I'm going to get you back over to our beautiful host so we can see if we have any questions that maybe I can answer and help you guys with this evening. Thank you.
Thank you, Francesca. That was an excellent, excellent presentation. It was a lot of information.
Yes.
And so I'm glad that you have shared your email address, as well as how they can get your book. It's anywhere you purchase a book, and she even has an ebook that you can download as well. Felicia, do you see any questions from our Zoom? folks. We do have one on YouTube.
No, I do not, but I have a personal question for her though.
Okay. Okay.
Francesca, um, it was probably maybe a year ago, and I had dealt with the attorney, and they had. I'm just trying to find out for other people, just to give them advice as well. They had put something on my credit report that was actually they had put it for collections, but it was incorrectly put. It was incorrectly placed. And so the attorney, he worked it where it was removed. Now, is it better to deal with the attorney when you're dealing with your credit report, or is it best to where you see these signs? You could be at the stop sign. You need credit help, dial whatever number. What is the best advice? Is it good just to get credit advice from signs, or is it best to see someone like you that have a lot of credit experience, or seek attorneys if needed?
Felicia, great question. Actually, I would say it comes down to both. It's in some instances, we at our company, we do have attorneys that we work with as well. If we get to a place with a client where we have those type of situations and we have contacted the bureaus, we've contacted the creditor or the collection agency, and they are adamant that they are not going to budge or remove this inaccurate information, which you as the consumer, hey, you're protected by the Fair Credit Reporting Act. So it's illegal. They really don't have a choice. So you have, I would say, if you're going to look into credit restoration, or even if you're going to do it yourself, and I think I hit on that a little bit in the book, just make sure that you are working with a company who is going to do things by the book, who's going to do things legally, who's going to follow the Fair Credit Reporting Act, who's going to make sure that as a consumer, they are abiding by the law and not just what they deem, to be what should happen, which one of those things is definitely not claiming identity theft for all these accounts that you may have sitting out there that may indeed be accurate and be your accounts, because we do see that happen. And that's why we have a lot of people who don't have a lot of faith in restoring their credit or with a credit agency. So it could be either way with your situation. I think it could have worked with you attempting to deal with the situation yourself, but sometimes it does take it escalating it to an attorney. And a lot of times when they are doing something wrong, illegal, they know the information is inaccurate. When they get a letter with that attorney's signature, a lot of times they respond a little bit different, especially if they are into doing shady practices, that particular agency or collection company that you were dealing with. So I say either way. I just say do your homework, and check whether it's you doing it yourself or you working with a credit company or an attorney. Just make sure that they have your best interest at heart as a consumer, and they're going to take the proper processes and procedures. So if it does have to be escalated to an attorney, that you have everything in order.
Okay. So,
awesome, because they had tried to take it to where they was going to do like a judgment, and I was like, and I was just so busy. I was like, oh no, you have this is not going to happen on my watch. So,
that's right.
Yeah, but I thank you. So I can give other people that advice as well. So I appreciate the response.
So we have a question on YouTube. Ashley wants to know, how long does it take for hard inquiries to come off your credit report?
Okay, so Ashley, typically a hard inquiry does stay on the credit report for 2 years. However, it depends on if that inquiry is on there legally or not. If like I spoke a little about earlier, sometimes you have situations where you go to the car lot and you just went, merely to look. You didn't go saying, hey, I want to purchase, hey, run my credit through 13 different people or any of that. So I will say that there are situations where we do see hard inquiries that are not correct, and we do dispute them, and it's not 2 years, but typically, Ashley, 2 years is how long they are allowed to stay on the credit report, and they naturally should fall off after that 2 year.
Awesome. So, Francesca, can I ask you to do a favor for me?
Sure.
Can you move your, go back to that last slide that gave us
Yes.
a summary?
Sure.
That's all the questions that we have so far, but we are here to take your questions if you guys think of anything else. But I always like to end every session with a high-level summary of, what each speaker was, kind of the information that we were getting back from the speaker. So what we've learned today is that 2 years is the optimal time.
Yes.
For the most bang for your buck when it comes to your credit score. So you started out in telling us that our credit score really does depend on what's included in your credit report. That's so important to make sure that your credit report is reflecting something that is accurate. Now, if you have something on that report that is accurate, but it's not helping you, you still need to fix that.
Right.
And you gave us some common things that happen when it comes to mistakes that are commonly found on people's credit report and why that happens. So that was good information. You also shared with us that they base the credit bureaus basically do a 2-year study. That's why this 2-year time frame is so important. They'll pull 1.5 million consumers credit 1 year. They'll wait 2 years later, pull those same people. Okay, who defaulted? And then once they figure out who defaulted, they get into the details of their credit report based on these 5 categories. The question is, what does their payment history look like? The ones that defaulted. What is their debt to credit ratio look like? People that defaulted. What's their length of credit? What is their mix of credit? They're trying to figure out what is it about those people that I can predict in a scoring model. So they come up with this scoring model. This is pretty much the 5 factors of the scoring model. Now, we're not going to get into the algorithm of how the model works. That's not important. What is important is the fact that you need to know what affects your score the most. You know what I find very interesting about this formula? If you take that 35% payment history, add that to that 15% length of credit, you got 50% of your weighting it out.
That's it.
So, I think I often see some big misconceptions when it comes to cleaning up your credit report with people who feel like, well, if I pay down my debt or if I remove some of the items on my report that's negative, then next week I'll get my score. No, boo.
No.
Take that thing out.
That's right. That's right.
Years. Yes. So I think another misconception is, well, not a misconception, but I think one of the things that people do that they may want to work on is you don't wait until you need a house to fix your credit score.
No.
Because in the best house, you need to be working in that 2-year time frame to fix whatever you need and give yourself 2 years. Then go get the car that you want that you can afford.
That's right. And that was good. The car, if you are looking to purchase a home, please don't go buy a car, because you know what I'm going to say? If I'm the lender, I'm going to say, oh, she just acquired a new debt. Oh, they just acquired a new debt. So they're going to have this debt for at least the next 4 or 5 years. And in some cases, people are, they're getting some car loans that's deep, but hey, they're looking at that, and that's going to play a major role. Again, like you just stated, if you know that you are going to be looking forward to purchasing a home, even if you have nothing on your credit. People get that misconstrued too. Oh, I don't have nothing bad. I got great credit. Sometimes you don't even have a credit score, because I have nothing to wage what you, how do you pay? I don't even know how you pay. So I can't, with good, reasonable judgment, extend you a $200,000 mortgage, because I don't know if you know how to pay anybody, because I have nothing to go by, and I think a lot of times people don't realize that, even if it's, you're just starting out, there's ways to have your rent. If you're a renter, have your rent report to your credit as a credit line. Have your utilities report as a credit line. There are different ways to help you without applying for traditional credit, which you may be denied for, because again, they're going to look at what do you have any credit history? How long have you had it? How do you pay your bills? You're like under this magnifying glass, and it's so weird. But like we stated the whole time, this credit report, guys, this credit score, with this credit report, it's like they're taking you and they're grouping you into this little bubble, and they're saying, okay, this determines their credit worthiness. This says whether we should lend them money or not. You can't go in and explain to the lender, well, the reason why I got behind this particular month was because my job reduced some hours. They're not doing that anymore. It's computers. So you have to be able to, like you just stated, look at the bigger picture, which I have clients who, we do the work. We get done doing the work. They're at a 676, a 682, a 661. Oh, well, I still need to be in the program just till you get me to 700. No, I'm done and you're done. What you're going to do now is you're going to continue to pay these bills right, because we've done the work. We gotta wait on this history. We gotta add to this. They gotta see you paying these bills, and I promise you, this score is gonna continue to climb. You've got to stay with the plan. We're done restoring credit at this point, but people don't understand that. They want that score.
All right, so Francesca, let's talk about one last thing before we wrap up, because Ashley brought up another comment that I thought was worth mentioning, and that we address this first. She mentioned that, how we have to be really careful when we go to certain people for credit repair, because a lot of times it's a scam. Mm-hmm. Can you talk to the people regarding how do you recognize that you're at a reputable credit repair person versus someone that's trying to take advantage of you? Okay,
well, one of the first determinants for me is, if you're a reputable company, I should be able to see you. It shouldn't be like, oh, I'm ducked off. I don't want nobody to see me, to know anything, about me. Secondly, I hear people who are saying all the time, oh, I paid $1,500 to have my credit restored. Mm-hmm. I went and paid them. They're going to sweep my credit and all this. Let me tell y'all, it's no such thing as a credit sweep. So they may do something called, oh, let me do a identity affidavit on your everything that's negative on your credit report. And it may come off for a little while, but when the law catch up with you, okay, because they're going to check to see if this really your stuff. And so when just one of those creditors is able to produce a contract that you sign, just one, they're going to send you some nice little information back and say, this is not identity theft. That is not credit restoration. That's not correct. And by doing so, I'm not teaching you how to be a responsible consumer. I'm teaching you how to scheme and scam. So I'm not teaching you how to recover from the road or the path you've been on. I'm teaching you that the most important piece of credit restoration for me, ladies, is the education. You know why? If I can teach you what this looks like when life happens, because it's gonna happen. It happens to all of us. When it comes and it knock on your door again, you gonna know exactly what to do. Or you gonna pick up the phone and say, hey, I got this going on. Instead of not paying your car note, and then you want to call me in 60 or 90 days, talk about, can I call and help you talk to them because they picked your car up? Why? Why did you not call me when you knew you could pay it in 30 days?
Mhm.
Don't run from them. But when you're looking for someone who is credible, you got to think about their passion. If they first objective is, are you going to pay me up front, which is illegal? I will say that you cannot charge for credit services up front. You cannot do that. You cannot charge them for this lump sum up front and say, hey, you pay me all this money and I'm going to do this. Because how can you guarantee somebody that you're going to get every last negative account off their credit report? Which, let me go back. Sometimes you don't need to mess with every negative account on your credit report. So that's a thing that people run into when they're trying to restore their own credit. Sometimes we talked about the length of credit history. If your worst account is 9 years old and the latest account you have next to that 9 years is 3 years old, I'm never gonna touch that bad 9-year account. I won't.
Right.
Mm.
Right. Because
do
it's
that.
15% of your score.
There you go. I won't do that, because guess
Yeah.
what's gonna happen if you're trying to close on a house? I'm gonna cause you to not be able to close on your house. And I know this. I know this because I'm a professional. So I know not to do that. But
Mhm.
you have people who don't care. All they want is you're gonna bring them 1,500, them 1,200, whatever it is. And this may happen or that may happen. And the sad thing is they don't even tell you they're filing all this identity theft affidavit on you.
Mhm.
And you get stuff in the mail, and then you freaking out because you like, I ain't tell nobody, I ain't file a police report. People are very creative. And so all I can say to you is, be diligent. If a person always, they hidden out, they running from you, they trying to get you to bring in all this crazy money. If you call me and you say, hey, I got 4 bad accounts on my credit and I need you to get them off in 30 days because I got to buy a house. I'm going to tell you, well, we ain't even having a consultation. Like, this not the program for you, because that's not how I work. I need to look at what's going on in your credit profile so I can see what your financial forecast looks like, because it may not just be 4 bad accounts. You may need to build credit. There's a lot of things that go into this score, like this slide we have up. And so you don't have the educational piece, and somebody who doesn't care and they're not a professional, they don't care that you don't have it. And they're definitely not going to stop you and say, hey, you came to me to provide a service and to help you. So therefore, I think we need to have a discussion about how we're going to go about doing that. So I hope that helps, Ashley.
You see, she's passionate about that thing.
I know, right? I just want to add on to that, Francesca. To the question that Ashley asked about when you can tell if it's when it's a scam or not. Because I remember this one gentleman I was speaking to, and we were talking about credit scores, and he was like, well, anything negative, I just keep reporting it and saying it's not mine, it's not mine. Then eventually it just comes up. I said, really? I said, how do you do that? How do you keep saying something's not yours and then eventually comes off? But that was his statement that he gave to me. So just to kind of like piggyback on what Ashley said, there are some people that literally that's out there that's doing these things in order to get things off, even though they know it's their bill, they're saying it's not theirs. And sometimes, I guess in his case, it did work. I mean, it did come off, but it does not negate the fact that he wasn't being truthful,
Right.
Yeah.
And
Francesca, one more thing, if you don't mind. Would you mind unsharing your
Sure.
presentation? Because we're right at our time, and
Okay.
I want to be respectful of our participants, but feel free to give us any final thoughts that you have.
Well, I was just going to say that is so true. You have to be careful because people will tell you, and when people are desperate, they're just looking for help. Honestly, I've seen situations where, let's say, for instance, you're disputing that you didn't have a car loan with somebody, and let's say, I do know that there are lenders, the car lenders, who you may have had a car loan with them 4 years ago. Something went left. Now you're trying to buy a new car, and they will actually finance you again. I've seen people who they kept saying that other car was not theirs, and then that company actually finances them again, and they just go and go and go, and they remove even the new car, and then they have an issue because they actually have a loan with them and they want that to be reporting. So yeah, it's just it can be more of a headache than a benefit to, you know, do things kind of, you know, in a shady type of way. But you're right, people do that to people.
So the moral of the story when we're trying to repair credit, and next week is when we will really get into the nuts and bolts of how to repair your credit.
Yes.
What does the dispute process look like for things that are on your report that's inaccurate? We're not
Right.
talking about things that's on your report that you want to lie about and get taken off.
There you go.
And that's probably one of the telltale signs of making sure that someone is reputable or not. You don't want to go in there and say, hey, I'm gonna pay you so you can get me a 700 credit score. It doesn't work like that. You need to know what exactly are they doing to help your credit.
Right.
And if any of that does not involve, you know, analyzing what's on your report, giving me an understanding of why my score is a certain way, according to that 5 pie chart criteria. If nobody's talking about that 5 pie chart criteria in which areas of your credit report is affecting you from that pie chart, you're probably at the wrong place.
There you go.
So that's probably that's it. But guys, you may want to consider, this is something that you can do on your own. When Francesca wrote this book, she wrote this book to a detailed level so that someone can pick it up and actually do it on their own. But if you need additional help, there are organizations like hers that will assist you along those lines as well. But the book even goes down to the extent of giving you examples of what a letter should look like when it goes to the credit reporting agencies and things like that. But we'll get into that next week. I want to first just, you know, thank you, Francesca, for going through the presentation, for your passion and your partnership. And thank you again, Felicia, for joining us. It's always a pleasure to have you join and contribute to the conversation. We will be right back here next Tuesday, October 13th at the same time, 7 p.m. Eastern Standard Time, 6 p.m. Central Time. The goal of the next presentation is to talk specifically about what happens if you don't have a credit score and you don't have credit. You need to build that credit up. The next thing we're going to talk about is, what if you have a low credit score? What do I need to do to rebuild my credit if I've damaged it in some kind of way? What is it that I need to do to work through that? If there's any inaccuracies in my report, what is it that I need to do to handle that? That presentation will be pretty light because we want to spend that time taking questions for anyone that have their own personal situation. So feel free to send those questions to me. You can email them to me at finedu@nabasouthern.org. You can also find that email address on our blog, www.nabafinancialliteracy.com. Also on our social media pages, feel free to comment, send us your questions. We want to be able to compile it and use that as an opportunity to help you next week. With that said, I think it's a wrap, ladies. It was a great discussion, very passionate, and you know I love it. And we will be right back here next Tuesday. Thank you everyone for joining us.
Take care. Bye-bye.
Bye.
Bye.